Every interview sounds the same. Stay invested. Maximize your contributions. Let compound interest do its thing. Cash is a drag on your portfolio. Every dollar sitting in savings is a dollar that is not working for you. And you believed it. You set up the automatic transfers. You maxed out your retirement accounts. You kept just enough liquid to cover a couple months of rent and maybe an unexpected car repair. You did exactly what every financial expert, every investing app, every personal finance book told you to do. Then you needed $10,000. Not because you were irresponsible, because your roof started leaking, because your company restructured and you spent 3 months between jobs, because your kid needed braces and your insurance covered about 40% of it. Normal life. The kind of stuff that happens to everyone eventually. And suddenly you realize something uncomfortable. Your portfolio said $200,000. But you could not actually use $200,000. You could sell some of it, wait 3 days for settlement, pay 15 to 20% in capital gains taxes on whatever had appreciated, and end up with maybe 70 to 80 cents on the dollar. That is if the market was not also down at the moment you needed the money, which statistically it often is, because financial stress and market stress tend to show up together. Your brokerage balance is not your money. It is your money minus taxes, minus timing risk, minus settlement delays, minus the emotional cost of dismantling something you spent years building. And nobody mentioned that part when they told you to invest everything. I call this the liquidity illusion. You look at your portfolio and you see a number, 200,000, 350,000, and that number feels like safety, like progress, like options. But try converting that number into usable cash on a Thursday afternoon when your contractor is standing in your kitchen telling you the water damage is worse than expected and you need $15,000 by Monday. Suddenly that $200,000 portfolio is not $200,000. It is a complicated series of decisions about which positions to sell, whether the market is up or down today, how much you will owe in capital gains, and how you are going to feel watching that number shrink after years of watching it grow. And you have to make all of those decisions while standing in a kitchen that smells like mildew. The wealthy never face this particular form of stress because they already have the cash. The portfolio stays untouched. The decision is simple. Write the check and move on. Their investment compounding continues uninterrupted. Their tax timeline remains intact. Their emotional relationship with their portfolio remains positive. My name is Evan, and I spend way too much time studying the gap between what the wealthy advise and what the wealthy actually do with their own money. Here is the thing that set me down this particular research path. When a billionaire tells you to invest everything, their version of everything and your version of everything are performing completely different math. A person worth $50 million who invests everything might mean they put $42 million into investments and keep $8 million liquid. That $8 million covers decades of living expenses, any emergency imaginable, and a war chest for opportunities. Their invest everything still leaves them with more cash than you will earn in your entire career. When you invest everything, you keep $9,000 in a checking account and pray nothing goes wrong for the next 6 months. Same words, completely different financial physics. And this is not a fringe observation. The data on what wealthy families actually do with their money is publicly available. The 2026 Dakota Global Family Office report found that the average family office allocates 31% of its portfolio to public equities, 10% to cash, and 14% to fixed income. That is 24% of their total wealth sitting in liquid reserves that are not stocks. Nearly a quarter of everything they own is designed to be accessible quickly without selling a single share, but it goes deeper than just keeping cash on hand. Because the really interesting part is not that the wealthy hold more cash than they tell you to hold. The really interesting part is why they hold it, and the reasons are structural, not emotional. Let me walk you through the 5 reasons the wealthy actually keep large cash positions, none of which have anything to do with being scared of the market. The first reason is one almost nobody talks about, and it is the most important. Cash is the price of admission to the investments that actually build generational wealth. Here is what I mean. The same family offices that hold 10% cash also allocate 42% of their portfolios to alternative investments, private equity, venture capital, real estate syndications, direct business stakes, hedge funds. These are the asset classes that have historically generated the highest long-term returns, often significantly outperforming public markets. But here is the catch. These investments are deeply illiquid. A private equity fund locks up your capital for 7 to 10 years. A real estate development deal might not return your money for 5 years. A venture capital commitment might take a decade to fully play out. You cannot call up your private equity manager on a Tuesday and ask for your money back because your furnace broke. And these investments do not just sit there quietly collecting returns. They make something called capital calls. When a private equity fund finds a deal it wants to execute, it sends a notice to its investors saying you need to wire us your committed capital. These calls can arrive with as little as 2 weeks' notice. If you cannot meet the call, you either forfeit your position or face severe penalties. This creates a paradox that completely changes how you think about cash. The wealthy hold large cash reserves specifically so they can invest in illiquid, high-returning assets. Cash is not the opposite of investing. Cash is what enables the best investing. Meanwhile, the standard advice pushes you to invest everything in the most liquid asset class available, which is public index funds. And index funds are good. They genuinely work for long-term wealth building. But one of the reasons you are told to stick with index funds is precisely because you have no cash cushion, which means you need to be able to access your money at any time, which means you need maximum liquidity, which means you are automatically locked out of the less liquid investments that generate higher returns. The wealthy are not holding cash because they are afraid to invest. They are holding cash because their investment strategy requires it. And your lack of cash is exactly what keeps you trapped in the one tier of investing that everyone has access to. Think about that for a second. The advice to invest every spare dollar in liquid index funds actually prevents you from ever graduating to the investment strategies the wealthy use. And the return difference is not trivial. The 2025 BlackRock Global Family Office Survey reported that alternative assets now make up 42% of family office portfolios, up from 39% just 3 years earlier. Nearly a third plan to increase their allocations to private credit alone in 2025 and 2026. These families are not adding alternatives because they are bored. They are doing it because the returns in private markets have historically exceeded what public markets offer, and these opportunities are becoming more accessible. Crowdfunding platforms, real estate syndications with lower minimums, and fractional private equity access are starting to open doors that were shut 5 years ago. But you still need cash to walk through them. A private real estate syndication might require a $25,000 minimum with a 5-year lockup. If every dollar you have is in an index fund, that door stays closed. The second reason the wealthy hold cash is something that behavioral scientists have studied extensively, and it is genuinely unsettling. Financial scarcity physically changes how your brain works. Researchers Sendhil Mullainathan at Harvard and Eldar Shafir at Princeton published research showing that the experience of financial scarcity, the feeling that you do not have enough money to handle what is coming, reduces cognitive performance by the equivalent of losing 13 to 14 IQ points. That is roughly the same cognitive impact as losing an entire night of sleep. This is not a metaphor. This is measured cognitive decline. When you are operating under financial scarcity, your brain dedicates enormous resources to the immediate problem of not having enough money. It is called tunneling. Your attention narrows. Your ability to think about long-term consequences shrinks. Your capacity for complex decision-making deteriorates. Now think about what happens when you are fully invested with almost no cash reserves. Every unexpected expense becomes a financial emergency. Every car repair, every medical bill, every appliance that breaks forces you into a high-stress decision about which investments to sell, when to sell them, and how much tax you will owe. Each of these decisions is happening while your brain is operating at reduced capacity because of the scarcity you are experiencing. The wealthy never enter this cognitive state. They have enough cash that unexpected expenses are minor inconveniences, not existential threats. Their brain is free to focus on long-term strategy and patient decision-making instead of figuring out how to pay for a new transmission. This is the part that really gets me. The advice to keep minimal cash reserves does not just hurt your finances. It actively degrades the quality of every financial decision you make afterward. You are making your most important money decisions with a brain that is operating at a significant cognitive disadvantage, all because someone told you that keeping cash was wasteful. The wealthy are literally thinking more clearly about money because they have more cash, and clearer thinking leads to better decisions. And better decisions lead to more wealth, and more wealth leads to more cash. It is a cycle that accelerates in one direction for the wealthy and spirals in the opposite direction for everyone else. And this cognitive effect does not just show up during emergencies, it runs in the background constantly. When you have minimal cash reserves, part of your brain is always calculating. Can I afford this? What if something breaks? That low-level financial anxiety consumes mental bandwidth that could be directed toward building wealth or recognizing a good deal when one appears. Studies on scarcity show that it reduces patience, increases risk aversion, and shortens time horizons. Every one of those shifts works against building long-term wealth. The third reason is about career leverage, and this is one that almost no personal finance content ever addresses. When you have no cash reserves, your paycheck is your only source of liquidity. Every bill you pay, every emergency you handle, every opportunity you pursue has to flow through your salary, which means you are completely, utterly dependent on your employer for financial survival. This dependency changes everything about how you operate professionally. You cannot negotiate aggressively for a raise because the risk of the negotiation going badly feels catastrophic. You cannot take a calculated career risk because 3 months without income would financially destroy you. You cannot walk away from a toxic work environment because walking away means your bills stop getting paid in 30 days. There is research that directly quantifies this. Studies show that 78% of employees who negotiate their salary receive a better offer. But here's what the data also reveals. The people most likely to negotiate successfully are the ones who can credibly walk away. Negotiation power comes from optionality, and optionality comes from having enough cash to survive if the conversation does not go your way. Let me put some numbers on this. If you earn $75,000 a year and you negotiate a 7% raise because you had the confidence and runway to push hard, that is an extra $5,250 per year. Over 10 years with normal annual increases, that single negotiation adds over $60,000 to your career earnings. And it compounds further because future raises are calculated on a higher base. Now multiply that by the fact that the average person changes jobs every 4 to 5 years, and each job change is another negotiation opportunity. The person with 12 months of cash reserves can take risks, demand more, and walk away from low offers. The person with 3 weeks of cash in their checking account takes whatever they are given and says thank you. Cash does not just protect your investments. Cash protects your earning power, and your earning power is the single largest financial asset you will ever own. For most people under 50, the present value of their future earnings dwarfs their investment portfolio by a factor of 10 or more. Protecting that asset with adequate cash reserves is not conservative. It is mathematically obvious, yet almost nobody frames it this way. Every personal finance article talks about protecting your portfolio from market downturns. Nobody talks about protecting your career from the downturns that happen when you are too financially fragile to make bold moves. The person who stays in a dead-end job for 3 extra years because they cannot afford to transition loses far more in lifetime earnings than they would ever lose to a market correction. The fourth reason gets into territory that makes the whole invest everything narrative start to look almost deliberately misleading. The wealthy do not just hold cash. They hold cash while simultaneously telling you that holding cash is a mistake. And there is a structural reason for this that goes beyond simple hypocrisy. Every major financial institution makes money when your money is invested with them. Asset management firms charge fees as a percentage of assets under management. Brokerages profit from transaction volume and account balances. Even the free trading platforms make money by routing your order flow to market makers who profit from the spread. Every dollar you hold in cash is a dollar that is not generating fees for someone. And the firms with the largest research departments, the biggest media budgets, and the most trusted brand names are the same firms with the most to gain from your money being fully deployed. The research they publish, the advice their representatives give, the content they sponsor, all of it is filtered through the lens of an institution that profits from investment activity, not from savings activity. I am not saying their research is fabricated. The data on long-term market returns is real. Compound interest genuinely works. Index funds genuinely outperform most active strategies over time. But the conclusion they draw from that data, which is that you should invest every possible dollar immediately and hold the absolute minimum in cash, that conclusion serves their business model at least as much as it serves your financial well-being. They will show you the chart of how much a dollar invested in 1926 would be worth today. They will never show you the chart of how much a strategic cash reserve would have saved you across a lifetime of emergencies, career transitions, and buying opportunities. The visible cost of cash, the inflation drag, is small and easy to calculate. The invisible cost of not having cash, the missed opportunities, the career stagnation, the cognitive load, those costs are enormous and almost never quantified. And the reason they are never quantified is that the people producing the research have no financial incentive to measure them. The fifth reason is the simplest and maybe the most honest. Cash is the only asset class that lets you act when acting matters most. Every other asset requires a transaction to convert into purchasing power. Stocks need to be sold, which takes time and triggers taxes. Real estate needs to be listed, shown, negotiated, and closed. Even bonds need to be liquidated through a broker. Cash is already in its final form. It is ready to deploy at the speed of a wire transfer. This matters enormously during windows of opportunity, which, by definition, are brief. When a business becomes available at a steep discount because the owner needs to exit quickly, the person with cash makes the offer that afternoon. When real estate prices temporarily collapse in a local market, the person with cash submits a bid while everyone else is still calling their financial advisor. When a private investment opportunity opens with a 2-week commitment window, the person with cash wires the funds and moves on. These windows create asymmetric returns. The discount you get for being able to act immediately, whether it is 10% on a property, 20% on a distressed business, or simply the ability to buy public equities at the bottom of a 30% drawdown, those returns often exceed years of normal portfolio growth compressed into a single well-timed decision. And the irony is that you can only capture these returns if you were losing money to inflation by holding cash before the opportunity appeared. The inflation drag on your cash reserves is the cost of the option to act. And like any option, it looks expensive right up until the moment it becomes incredibly valuable. Now, let me make this contrast tangible. Poor Peter and Rich Richard both earn $85,000 a year. Same city, same company, same access to the same financial advice. Poor Peter follows the playbook perfectly. He keeps about $8,000 in a high-yield savings account, roughly 2 months of expenses. Everything else goes straight into index funds. His investment app sends him notifications about his portfolio growing, and he feels like he is winning. Rich Richard earns the same $85,000, but he keeps about 15% of his total assets in liquid reserves. His friends think he is being irrationally cautious. His coworker sends him articles about how inflation is eating his savings. He ignores them. Year 3, their company restructures, and both of them are in roles they dislike. Peter cannot afford to leave. His cash covers 6 weeks of expenses at most. He stays for 2 more years, taking modest 3% raises, growing increasingly frustrated and disengaged. Richard has 9 months of expenses in cash. He quietly starts interviewing. When he gets an offer at a competing firm for 15% more than his current salary, he negotiates hard because he can afford to walk away if they say no. They do not say no. He starts the new role making roughly $98,000. Over the next 7 years, his higher base compounds through raises. By year 10, the earnings gap between Peter and Richard is over $134,000 from a single career move that was only possible because Richard had cash. Year 5, the market drops 28% during a correction. Peter holds his positions, which is good, but then his car engine fails and he needs $7,000 he does not have. He sells investments at the bottom. Those shares, if he had held them, would have been worth roughly $12,000 just 4 years later. Richard pays for the repair from his cash reserves. His investments stay untouched. He then takes another $20,000 from his cash reserves and buys index funds while prices are depressed. 4 years later, those shares are worth roughly $34,000. Same car problem, same market crash. Peter lost future value of about $12,000. Richard gained about $14,000. The swing between them from that single event is $26,000. Year 8. A small commercial property comes available in their neighborhood at 30% below market value because the owner is going through a divorce and needs to close fast. Peter cannot move, no liquid capital. Richard puts down a deposit from his reserves and closes within 3 weeks. The property appreciates to full market value within 18 months and generates rental income on top of that. Same neighborhood, same opportunity, completely different outcomes. After 10 years, Peter's net worth is about $170,000. Richard's net worth, including the rental property and his higher salary trajectory, is north of $460,000. The gap is $290,000, and the majority of it has nothing to do with investment returns. It comes from career leverage, avoided forced selling, and the ability to seize one opportunity that Peter was structurally locked out of. Here is the part that should bother you. If you showed a financial advisor both of their situations at year 0, the advisor would have praised Peter and criticized Richard. Every single metric the financial industry uses to evaluate portfolio performance would have ranked Peter higher for the first 2 years. The models were correct about the math and completely wrong about the outcome, because life is not a spreadsheet. The financial industry will tell you that Peter lost maybe $6,000 or $7,000 to inflation by keeping too much cash over 10 years. What they will never tell you is that Richard gained $290,000 in real wealth because he had cash when it mattered. The cost of holding cash is visible, small, and easy to put on a chart. The cost of not having cash is invisible, massive, and systematically excluded from every piece of mainstream financial advice you have ever received. And this is not about being pessimistic or expecting the worst. Richard did not hoard cash because he thought bad things would happen. He kept cash because he understood that both bad things and good things require the same resource to respond to. An emergency and an opportunity look very different emotionally, but they demand the exact same thing from your finances: liquidity. So what does this actually mean for you? It means the gap between what the wealthy advise and what the wealthy do is not accidental. It is structural. The wealthy hold cash because cash enables access to better investments, protects cognitive function, creates career leverage, and provides the ability to act during brief windows of opportunity. The advice to invest everything and hold minimal cash keeps you in a cycle where your brain is taxed by scarcity, your career is constrained by dependency, and your investment options are limited to whatever is most liquid. And here is the uncomfortable truth underneath all of it. The system does not need you to hold cash. The system needs your money deployed, generating fees, providing liquidity, and maintaining the buying pressure that keeps asset prices elevated for the people who are already wealthy. That does not mean investing is wrong. Compound interest is real. The long-term trajectory of the market genuinely favors patient investors. But the conclusion that you should hold the absolute minimum in cash is where the advice stops being about your well-being and starts being about theirs. The wealthy know this, which is why they ignore their own advice. They keep 10% in cash, another 14% in fixed income, and invest the rest with the confidence of someone who knows that no emergency, no opportunity, and no market crash will ever catch them unprepared. You do not need millions in cash to start changing this. You need enough so that your next emergency is not a financial crisis. Enough so that your next salary negotiation happens from a position of strength instead of desperation. Enough so that when an opportunity appears, you can at least ask the question instead of immediately disqualifying yourself. Start with 3 months of expenses if you have nothing, then 6 months. Then build what I call an opportunity reserve alongside your investments, money that is not allocated to any specific emergency, but exists specifically so you can act when acting matters. Put it in a high-yield savings account or short-term treasury fund where it earns something while it waits. Do not leave it in a checking account earning nothing. but do not invest it in anything that takes more than a day to access.